services does the nascent fund merging and startup managers?
I'll explain the background to why we formed it. There is a surge, if you like, or there are a lot of new funds being set up at the moment worldwide. They tend to break down between the larger funds, which can attract an institutional investor, and by larger, they're usually called small, but anyway, they're somewhere above 100 up to 200, 300 million. And then those below 100 million, where raising money has been very difficult. I glibly say that in 2008, 100 million was petty cash, and today it's a lifelong ambition of many startup managers. Raising 100 million at that level is very difficult. If you're a startup manager with, let's say, less than 50, or, as an awful lot are, relying on that famous investor of family and friends, and therefore they could well be down at less than 10, the cost of setting up a fund is very expensive. It's going to be at a minimum, whether you're in the Caymans or Malta, minimum 30 to 35,000 euro or dollars to actually establish the fund, going up to 150, depending on the lawyer you use or lawyers, and that is crippling for a fund of, let's say, 5 million, or even 10 million. And then the operating costs of a standalone fund amount up to, very rarely will you be able to keep it less than $100,000 a year. So that's also very expensive on a 5 or 10 million fund. So what we decided was that we would see if we could do something to help the startup managers, not purely for altruistic reasons, but because we wanted to be the administrator of funds in the long run. And so what we've done is we have created the Nascent Fund. The Nascent Fund is a Maltese umbrella fund. It has segregated cells, so there's no cross-collateral risk between one and the other. And it's very substandard structure. It's a boilerplate structure in which a new manager can slot in details about the manager and the strategy. But we have the same bank as the banker to the fund, JP Morgan. We have a local Maltese auditor, very respectable firm, and same board. And the whole thing is very boilerplate, except for the strategy and the managers coming in. We offer one of those funds for €8,000. The objective and the timing or the length of longevity of this fund, we expect to be about 2 years, because we give a very favorable cost structure for operating the fund for the first 2 years. It goes up a bit in the second year, and then in the third year it becomes about as expensive as running a standalone fund. And the reason for this is that we believe that if what we're trying to do is to offer managers a time, a bit of breathing space, and if after 2 years they haven't been able to generate either a track record or raise money or both, then they have to seriously consider whether they're in the right business, or should they, as I say, go back to the farm. If they are in the right business at that point, then we say, okay, what we want you to do now is to go out and establish your own fund, and that can be wherever you were going to do it in the first place, or it can be another Maltese fund or whatever, depending on the arrangements. And one of our conditions is that we'll be the administrator for 3 years.
Now, how many funds have you currently got on the platform, and what is your target number?
Our target number is theoretically unlimited, but I would think that we would consider ourselves very happy if we got one a month after things started rolling. We have a number of inquiries at the moment. As of today, I think we've got 3 or 4 on the fund, but maybe 3. And we certainly have another 3 or 4 that are in the wings waiting to come onto the fund. And even at this level, some of them have a problem raising the money from the family and friends. But given that we're expecting the average fund to have a 2-year lifespan or less, then it is quite conceivable that, or the logic is that after 2 years, funds will drop off and new funds will come on. So we have a fund coming on and off every month, which should be
What do the managers have to have in place to get onto this platform?
We obviously do KYC type checks. That's fairly straightforward. But the other thing is that it's a Maltese fund, therefore they have to be regulated in a jurisdiction that's acceptable to Malta. And that's not usually a criminal for most people.
Now, what are the benefits for you for helping the startups, and have you suffered losses?
We will suffer losses. This is a loss leader. The actual nascent fund will probably wash its face once we've got up to about 12 or 15 funds. We charge, in the fee structure I'm talking about, we charge 20 basis points for all expenses other than audit and administration, and obviously transaction costs. Which sounds a lot of money, but it isn't in fact. You think we were talking about excuse me, government fees, directors' fees, all those peripheral expenses that are done at the back. And it certainly isn't a lot when you're talking about a $3 million fund. So it costs us money. The reason we're doing this is that at the end of 2 years, we're hoping they will have a standalone fund if they have proven themselves in those 2 years, and we will become the administrator. Part of the deal is that at the end of 2 years, when they leave the nest, we will become the administrator for a minimum of 3 years. That's not, I mean, the choice of 3 years is fairly arbitrary, but it's done on the basis that most funds that last 3 years last a long time, and you have to really screw it up as the administrator to be thrown out.
Why is the nascent fund so important to startup managers in this incredibly tough capital raising environment?
Because it's an incredibly tough capital raising environment. It gives them a stepping stone, if you like, in time from, there's a catch-22. You need to raise money in order to attract investors. They need more money in the fund, and you need a track record. You've got to have money in the fund in order to be able to trade and have a track record. And you can't do that for a standalone fund with 3 or 5 million, but you can with our fund. You can build it up. So we give them a 2-year breathing space that enables them to run an investment product that isn't being offered to people on the basis of pro forma trading. It's being offered on the basis of actual trading.
Do you see the capital raising environment becoming easier in the next few years, and why?
Yes, I think it's going to become easier. Not going to be a sort of flood of money, but what we have noticed is the return of the high net worth investor internationally. High net worth investors and family offices really felt pummeled by 2008, and the hedge fund industry in particular, because they tended to be, in comparison to institutions, overweight in hedge funds, so they took the bashing with all their money. Whereas institutions were able to see that the 5% they had in hedge funds or in that market actually outperformed the rest of the portfolio very well. I think the high net worth lost money and they weren't expecting to at all. The reasoning for it wasn't necessarily the manager's fault, in some cases it was, but they still, went back to the kennel and let their orders, or back to their basket. They're now coming out again and there are many more high net worths around now, surprisingly, particularly in Asia. And I think that they are going to be looking at this market as being one that is safer is probably the wrong word, but less risky than traditional markets, and the family offices are the same.
Now, my final question is, what improvements or additions are you making to the platform?
What we are doing is we're looking at setting up a US partnership structure similar for US investors, and a Sharia version for Sharia investors, because we've had inquiries for both. And that's how it will develop down the road. We'll get an investor who will come in, or a manager who will come in and say, I would like to have X, and now I know what it is at the moment. And we'll consider that and say, yes, we can do that for you, and we think it's a good idea. So we'll do it for him. So it'll be developed by evolution.